From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the Payrolls Report delivering big gains, providing rocket fuel for the tapering debate, driving Treasury yields higher and the curve much steeper. We begin with the big issue, a rock-solid Payrolls Report.
Let's be clear.
This is a great report.
Very important one for the economy.
This is a very strong report across all metrics.
It's going to go a long way in encouraging the Fed.
If anything, it pulls forward maybe tapering.
This is time for the Fed to start tapering.
If the Fed tapers, you take some of that froth off the liquidity dynamic.
I'll put one caveat in there.
We've had a lot of kind of negative surprises, focused really on the Delta variant.
This Payrolls report happened before the surge in the Delta variant cases.
Reasons to continue to be patient.
The next Payrolls report is going to be the decision-making report for the Fed.
The number in September.
The next 30 days of data is going to be really, really critical to watch.
Let's bring in the panel. Joining us now is Manulife's Francis Donald, Morgan Stanley's Michael Kushma, and Bank of America's Mark Cabana. Francis, I want to begin with you. Your first take from the data we saw earlier this morning.
Well, let's not read too much into it. We still have massive distortions in a lot of our economic data. The non-seasonally adjustment number was down 133K. That's not to say we should read into that, just that we still have some serious distortions. And like a lot of what you showed on that pre-tape, this number is lagging. It's backward looking. I need to know, is Delta really reducing mobility as we see some seeds of? Are supply chain disruptions going to reduce demand? I care much more about where we're going now that we have these new macro factors at play than where we were during a reference week, which I don't feel was very representative of what the next 3 months is going to look like. So good report. I can check every box, but this is not the decider report from my view.
Interesting. Mark Cabana, how dated is this data?
They're great points. We need to see more payroll reports like this in order to give the Fed confidence to potentially pull forward the timing of taper. I don't think that they're there quite yet, but for the Fed, this is an incredibly strong foundation that they can build off of. But seeing how incoming data evolves, especially given the uncertainties around Delta, will be critical to give them that confidence to move forward with the taper.
Michael Kushma, your take. How much progress did we just make towards substantial progress?
At least 1/3. I think that we needed several months of this after being disappointed over the last several months. Even though those numbers were strong, they weren't strong enough given how strong the economy was. So I think that what we're seeing today is the first signs that the reopening, in terms of the reopening sectors of the economy, leisure, entertainment, travel, are having the appropriate impact on employment. But for substantial, we're probably 1/3 there. We need a couple more months of this, but certainly lays the groundwork for increased probability that the Clarita view expressed the other day may be correct.
Well, that's the question, Michael Kushma. Do we need one more good report or do we need two? Does it even really make a difference? It depends who you listen to. Governor Waller of the Federal Reserve said in the last week, he talked to CNBC in the past week, the following: I think you could be ready to do an announcement by September. That depends on what the next two jobs report do. If they come in as strong as the last one, then I think you made the progress you need. Well, we've had one. Governor Brainerd said last Friday the following: I expect to be more confident in assessing the rate of progress once we have data in hand for September, when consumption, school and work patterns should be settling into a post-pandemic normal. Francis Donald, your view on this? If you take the Governor Waller take, then it's September 3rd, get a good solid print there. September 22nd, we're on. If you're Governor Brainerd, you need to wait for the September data that you'll get in October to really get a better picture for the back to school and for the kind of things that you described. Which one do you think is the one worth listening to just a little bit more closely?
This is a Fed that wants to taper, whether it's September or October or November. That doesn't change the grand scheme of things. Listen to how the Fed is talking to us. It's just really a minutia about which individual month it is. So I think that at Jackson Hole, we get strong indications. And even though I have a lot of concerns about downside risks, the Fed can easily say, we're just adjusting demand and the size of our QE to match supply and issuance. So therefore, it's not even effectively a reduction or a tightening per se. They're going to have enough that they can actually move forward with this very small move. What matters to me in the data is how they taper and what signal they provide. How fast they taper is an indication for whether or not they can hike in 2022, as many Fed officials want, or in 2023. And I suspect the data that we see in the next 30 days is more about the how of the taper than the when of the taper.
Well, Mark Cabana, let's talk about that, the sequencing of events that you expect, not through to the end of the year, but into next year as well, through 22?
Yeah, so we think that we're going to get a pretty strong signal for taper, likely at the September FOMC meeting, and that the Fed will then start the tapering early next year in January. Now, given how strong the data was today, we think that the risks are that it happens a little bit earlier. But look, Brainerd is a very important voice at the Fed. She's clearly in no rush to move forward with this. She's probably a bit in the minority camp right now amongst the Fed, but her voice matters a lot. And that does risk potentially allowing the Fed to have a bit more time and, again, wait for this data to provide the signal and then start. When they do start, we think that they're going to plan to go $10 billion per treasury in treasuries per meeting of a reduction, and $5 billion in mortgages of a reduction. But importantly, the Fed will likely say that it's data dependent because there's a lot of uncertainties with the virus, and that's going to give them the flexibility to potentially accelerate or slow down the taper process if need be.
Before we dig into that a little bit deeper, Michael Kushma, do your expectations line up with Mark Cabana's?
I think they're very similar. Things look like on a really nice trajectory. There are obviously potential roadblocks along the way for that scenario to unfold. But right now, we do look to be on that trajectory. You could easily argue that while employment is about 5 million plus or below where we want to be, monetary policy is exceptionally low. And real yields today are lower than they were in March last year, or even September of last year, when 10-year bond yields were well below 1%.
Yep.
Why did the Fed want additional easing from then to now? Shouldn't we have less easing? Just dial it back to where we were at the beginning of the year even.
What does it mean for this bond market? That's a big question right now. We've seen a big range through this week. We had a little look at 130 in today's session, 112.58 on Wednesday. Mark, you've made the point, a rapid rate rebound seems unlikely. Why, Mark?
So, look, we're still fundamentally in the higher rate camp. We think that overall economic growth and inflation, plus the commentary that we've heard from the Fed, should allow rates to reprice higher from where they are today. But we've been encouraging clients to be patient in expressing that view, primarily because in August, you've got a whole host of factors that work against you. Number one, August seasonality tends to be quite strong, and it typically suggests that rates fall. Number two, you've got a Fed that is still adding liquidity through not only their ongoing QE, but also a drawdown in the Treasury's cash balance that puts more cash in the market that needs to find a home. And you've got a bond market that, according to our surveys, still suggests that it's underweight. Positioning needs to get cleaned up before you're going to have the possibility of a more sustained rate increase. And so for all of those reasons, we think that we're likely to see rates rise further once we get into the fall, and less likely to see a material repricing this month.
Francis, I wanted to give you the opportunity to talk about your view, because you've been in the peak macro crowd for quite a while now, and you've made the argument on this program, on others, that you think we've already seen the peak in a 10-year yield. Francis, how does this data that we got today inform that view?
Well, it doesn't, because we don't take one data point that's hugely skewed and say it changes the entire narrative. The problem with peak macro is fun to say back in April or May, but it is consensus. I think it is priced. The bet now is, does growth deteriorate even faster than those who claimed for the peak? And there are risks that this happen. We need to monitor Delta and what it's doing to the supply side of the global economy, particularly in Asia. This is not a demand side story. People want to go and buy things. They want to get onto flights. But if those things are not available to them, then we actually see a reduction in demand. U.S. housing is a really good example of this. People want to buy housing, or they have up until now, but it's been a drag on growth because of the supply side of the story. So when I look at this bond market, I agree heavily with Mark. I have all those factors on my list as well. The challenge is, do you take big bets when we still have a number of issues ahead of us that could imply even more downside to growth than even what was expressed in peak macro? The other thing I'll say here is peak macro did get well expressed within the bond market, but less so in other asset classes. So maybe if you're still feeling nervous about the macro environment, you're maybe looking towards sector or relative value calls instead of saying rates are going to plummet from this level now.
Francis, supply constraints, I want to pick up on that. We had a really hot ISM earlier in the week, and then you dig into the industry comments and you just hear the following. Costs have risen dramatically in the last 45 days. Labour shortage continues. Increased pay, but the shortage continues. Continued shortages, additional delays. Michael Kushma, to have a view into next year, you need to have a view on these supply constraints and how they will heal into the end of this year. Do you have the confidence that they will?
Not completely. I think there's a slow process unfolding. There's no doubt there's help wanted signs everywhere I turn, whether they're sort of hourly jobs or mechanic jobs or whatever they are. They're out there. We can't seem to fill them fast enough. We can't seem to build enough computer chips, semiconductors to meet demand for them. And those issues are not going to go away. I think the recovery in the economy has been so fast, it's outpaced the ability of the private sector to respond to that. And that's going to take time. But importantly, longer term, I think the really question is, where is the terminal Fed funds rate? So when you talk about 10-year bond yields or longer, where is that number going to be? The Fed talks about 2.5%. The market believed 2 earlier this year. Now it's well below 2. Is the market going to believe that post-pandemic, when this thing gets cleaned up next year, hopefully by the middle of next year, in terms of understanding exactly what it's like post-COVID, will we be on a trajectory which is similar, dissimilar, how dissimilar from the pre-pandemic trajectory? Right now, we seem more pessimistic than we were before, which I think is wrong. So I think yields should go back to where we were at least, but maybe not a whole lot higher. We had peak optimism about the medium term, and 10-year treasuries only got to 175, 180.
Mark Cabana, final word on that, where the terminal rate is, in your mind?
We think the market's too low. The market right now is around 150. We think that it's going to realize likely closer to 2%, if not maybe even slightly above that. And there's a lot of reasons for pessimism in the market right now. We hear this peak growth argument a lot. We hear inflation headwinds argument a lot. COVID is a natural downside risk. Debt service costs. All of these factors are being cited for why the Fed won't be able to raise rates very far. But look, it's going to depend upon the underlying data. That data, we got a very encouraging point on today. Much is going to depend on the Delta variant, but we do think it's going to fade over time and allow for the Fed to raise rates by more than what the market is currently pricing, given the very strong input from stimulus and the fact that that stimulus is not yet done.
Let's continue that conversation. Mark Cabana, Michael Kushma, Francis Donald sticking with us. Up next, the auction block. Junk bond issuance remaining hot, hot, hot. Borrowers rushing into beat the summer lull. That conversation coming up next from New York. This is Bloomberg. From New York, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with bond sales remaining light this week. Issuance across all sectors only reaching 7 billion euros amid a seasonal slowdown. A different story in the US. A steady stream of high-grade supply boosting weekly sales above $30 billion for the first time in 2 months. And an active week in high-yield markets as well, pricing roughly $15 billion, making it the busiest week of sales since mid-April. Back with us, I'm pleased to say, Francis Donald, Michael Kushma, Mark Cabana. Let's start right here. Financial conditions. Primary market's still wide open. No problems here whatsoever. Financial conditions for Goldman, their index that many people follow, Francis, has been at record looseness. We've seen it again. And a question that I've heard asked a million times, Michael McKee's really pushed this in the news conference with the Fed chair many times. What can we buy for 120 billion that we can't get for 100, 80, 60, 40? Maybe even nothing over at the Federal Reserve. How much of a difference do those QE purchases actually make, Francis?
Well, effectively, a lot of research out there saying it's not actually having a material change on the economy, particularly not the real economy. So the risk is, how do you actually pull back without significantly tightening liquidity and pulling the floor out of one of the pillars of the market? So I think this is going to be a challenge for them. But as I said earlier, there is going to be less issuance coming out of Treasury. And the Fed can very easily say, we're pulling back just to maintain the same level of easiness within this market without actually saying this is an active tightening. So I think there's some technical considerations. I know Powell says these are things that we say we don't really understand what's going on in technical factors, but the technical factors are at play and they are relevant.
Mark Cabana, your take.
Agree with that. I think that this is a market that can certainly withstand a Fed taper. Expectations are high that the Fed will taper. Liquidity is incredibly abundant, depending on where you look. I mean, there's almost $1 trillion of excess dollars every day that's parked with the Fed at the overnight reverse repo facility. So this is a Fed that certainly can taper. The challenge for them, though, is doing so in a way that doesn't seem like they are becoming overly hawkish. That's why expectations for taper are so important. And again, from what we can tell, where expectations are today, they're squarely centered on the Fed starting the taper process early next year in January. And that's why we think that the Fed is likely going to follow that path so that they don't overly spook markets and tighten conditions unnecessarily in their view.
And what will ultimately matter here, Mark, is whether they can aggressively de-link any communication about tapering from the conversation about raising interest rates. Michael, so far, so good in your mind. Are you confident we're getting that kind of communication? The likes of President Kaplan, who really wants to remove some of this QE, he's been pretty aggressive on that too. Don't take what I say about QE as any kind of signal as to what I may or may not want to do with interest rates. Do you think that will be the story into New Year?
I think it's going to be challenging. I think President Bullard said something different. He said we need to taper fast so we have flexibility to raise rates faster than we want, given that we expressed to have some time between the end of tapering, the end of QE and the beginning of tightening. So we need to get that done quickly, maybe faster than expected, $30 billion a month to get rid of it so that we have flexibility to move when we want to move. And he thinks it could be moving much sooner in 2022. I'm a little skeptical about moving that fast, but on the other hand, the amount of $120 billion a month is becoming a small amount, considering the size of the Treasury market, the size of outstanding issues, and given the imbalances which exist in the bank excess reserves market and the reserve repo facilities. You could easily argue, as has been discussed, that a tapering is just to clean up technical issues in the Treasury market.
So here's the question for all three of you.
But how do you communicate that's the factor?
Yeah, I don't know. I don't know, and clearly the chairman has some problems to doing that because he just raised his hands with no idea, no clue as to why Treasury yields were down here. Francis, let's start with you with this question. If we do begin to taper in the coming months, if it's September, the announcement, if it's later on, whatever, is that bullish or bearish for Treasuries?
Well, traditionally, when the taper starts, it's actually bullish for Treasuries. But I come back to it's not the when, it's the how. Can they pair the taper with pushing out all expectations of a 22 rate hike and try to steepen the curve? And that, again, comes down to communication. This is why there's so much, breadth of ideas about what the bond market is going to do, because it's going to come down to this communications angle. And it's going to be really hard for Powell to say, well, I don't want to hike till 2023, when he's got a significant share of the FOMC that clearly wants a 2022 taper. So, again, I come back to it's not the when, it's the how that's going to be the big determinant here for what bonds do next.
Mark Cabana, give me a final word on that if you can.
So I agree that the when, there's very small degrees of variation around that. The how is important. How quickly do they do it? Do they go at the pace that everybody expects? Faster, slower? How flexible do they make it? And then what's most important is what is the signal about how taper should be interpreted in terms of actual rate hikes? I think Powell needs to do a better job of delinking the two, and I do anticipate that we're going to hear that. By the way, we do think that in a moderation in inflation next year, coming off of some of these base effects and as supply comes back online, will help the Fed delink them.
Michael Kushma, your take.
I think that it's very important to see what happens to inflation. If inflation moderates as expected, as President Chairman Powell talks about, they should be able to proceed slowly. If inflation stays stubbornly high, and there are clearly members of the FOMC who think this is not all transitory inflation, some of it's going to stick more longer term, they'll need to get it done faster. And that debate should be quite vocal at the FOMC, and it'll be interesting to see how that comes out.
Michael Kushma, Mark Cabana, alongside the wonderful Francis Donald, sticking with us. Still ahead, the final spread, the week ahead, featuring another round of Fed speak and some big US inflation prints. That conversation coming up next from New York City. This is Bloomberg. From New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, a full slate of Fed officials speaking with Bostic, Barkin, Mester, Esther George, all on the calendar. I bet you can't wait. The US Treasury auctioning nearly $130 billion in 3, 10 and 30-year paper throughout the week. US CPI coming on Wednesday, PPI and initial jobless claims on Thursday. And finally, watch out for a potential Senate infrastructure vote coming potentially as soon as tomorrow. With some final thoughts on all of this, Francis Donald, Michael Kushma, Mark Cabana, still with us. Francis, let me come to you. What are you looking for next week in that inflation number?
I just want to see if it's supply side driven or demand side driven, because if the inflation we're getting is because of semiconductors in Asia and port closures and lack of supply, then the Fed cannot fix it with rate hikes to the same extent as if it's demand side. So that might be a little subtle. It's not a single light item, but what is the trend there? Supply versus demand. That's the key to the next 6 months for me.
Michael Kushma, your take.
Very similar. Transitory versus permanent. What's the mix? And we're not going to know for a while. We may not know till after September, when excess unemployment benefits roll off, and back to school, back to work. How that transpires in September, October. We're already seeing companies roll back the times when people go back to work. How much is that going to impact the economy, impact confidence in terms of behavior?
Mark Cabana, are you on the same page?
3 things to watch for next week, I think. Used car prices and CPI. That's the biggest component that we have seen. If it moderates, that's going to go a long way to helping sort out the transitory versus persistent debate. Second, airfares, lodging away from home. Where are we in the reopening? How do we see that evolving? And number 3, and perhaps most important, it's the University of Michigan inflation expectation data to round out the week. This is the most important data point, we think, for the Fed right now, given all of the push and pull of transitory or not dynamics in the hard inflation data. Where are expectations? Do they remain relatively stable? If so, then the Fed has more time. If not, then they might need to get on with the taper and potential rate hikes next year.
One more round, guys, is the rapid fire round. We have time for this. I'm going to squeeze it in. Tapering in September or beyond? When do we get the call? September or beyond? Francis?
September.
Michael?
September.
Mark?
September signal, December announcement, January start.
That's very specific. Let's do rate hikes. 22, 23 or 24? Which one, Francis?
Late 2023, still a possibility for 2024.
Mark?
Late 23, 24 is tough with the election.
Michael?
Q1 23.
I've got to squeeze this in. Are you more confident we've seen the lows on 10-year yields this year or the highs on 10-year yields? More confidence we've seen the lows or the highs? Mark?
Lows.
Michael?
Lows.
Francis?
I'll go contrarian, highs.
There we go. Guys, it's been good to catch up. Thank you. Francis Donald, Michael Kushma, Mark Cabana. Enjoy your weekend from New York City. We'll see you next week on Friday. Same time, same place. This was Bloomberg Real Yield. This is Bloomberg TV.